Welcome everyone to tonight's Hook Up with Real Estate Masterclass. I'm Donna Hook, my husband Ken Hook, and we have a very special guest tonight, Senate Eskridge, and we'll talk more about that in just a minute. So I would like to share with you, and let's see, it's not working, our mission, which is to provide aspiring and early real estate investors with the education, skills, and opportunities to invest in real estate while simultaneously avoiding costly mistakes like those Ken and I made early in our real estate journey. We learned a lot, but we own some single family houses for a while now, since 2004. And probably some of the mistakes that we made, Senate is going to be talking about how to avoid today, like partnerships, which is a good one. So I'll just go on and say that there are two ways to stay connected to us. The first one is on YouTube. So sometime within a week, this masterclass will be up online, and you can find us at youtube.com/the @hookup with real estate, all one word. And if you want to stay connected to our community, we also have a Facebook group, and it's facebook.com/groups/hookup with real estate. Let's move on to the next topic. We did publish our calendar for this year, so normally we're on the fourth Wednesday of every month, except there are two exceptions toward the end of the year to avoid the conflicts with the holidays. So you can grab a screenshot of that if you like. And when I was talking about those mistakes, I wrote about them in a book called Real Women in Real Estate, which you can get for $2.99 on Amazon, or I can send a soft cover signed copy for $17. It's not just my story. There's 26 other chapters in there, so you really get to learn from a diverse group of women. And so it's an interesting read. And next, I would just like to say that my husband, Ken Hook, is a New Jersey realtor. So if you're ever in need of Jersey realtor, he's with Weichert. And Ken, would you mind reading this disclaimer?
Yes. Welcome, everybody. We appreciate you attending the Hookup with Real Estate Masterclass presented by co-hosts Kenneth and Donna Hook. The content we provide is strictly for educational purposes and not intended as legal, financial, or investment advice. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Neither Hookup with Real Estate nor its representatives will be liable for any outcomes resulting from the information provided. Seek professional advice before making any real estate or investment decisions. By attending, you consent to this event being recorded and understand that internet security is not absolute.
Thank you, Ken. And the quote of the day.
The roadmap to success is paved with dedication, persistence, and a willingness to learn from every step. Unknown.
So now I would like to introduce our very special guest, Senate Eskridge, who was born and raised in Twin Falls, Idaho. He and his wife, Carrie, have raised 5 children in the Magic Valley area. When asked if they have children, his answer is always, nope, we have adults. Senate and his wife are both serial entrepreneurs, and together they founded the Idaho Summit. Senate is also an active multifamily real estate investor and is a Wheelbarrow Profits Academy Coach, which is a multifamily investing coaching program. He's worked within several industries in the Magic Valley area, including owning his own financial firm. He has a vast experience, which makes him a perfect fit for multifamily real estate investing. And he currently owns 647 units across the country and counting. And he's helped nearly 100 people from all walks of life invest in multifamily real estate. So helping people find solutions is one of Senate's many passions. Given his personal and professional experiences, he can quickly analyze issues and identify solutions for others. In fact, you can often find him deep in conversation with someone solving all the world's problems. Senate is active in his community, heading up the Magic Valley Real Estate Investors Meetup. And he's also involved in the Twin Falls Chamber of Commerce and Snake River Business Network. He is a self-proclaimed self-development junkie, and he and his wife travel the country to attend personal and professional development seminars, seeing influential speakers such as Ed Milet, Luke Red, Grant Cardone, Tony Robbins. He loves to travel all over the world, but their favorite place is to visit Disneyland. When at home, Senate enjoys golfing with friends and catching performances at the local playhouse. He strongly believes in supporting local businesses and spends the majority of his time doing just that. Please help me welcome Senate Eskridge, who will be sharing his knowledge on the roadmap to success, how to find and evaluate great real estate investments. Senate. I'm gonna stop
Thank you
sharing.
for that great introduction, Donna. That was awesome. Good job.
Thank you. So tell us about how you got started and all this fun real estate stuff.
That's a really interesting story. I'm going to give you the short version because, as I'm sure you can imagine, it's really long and a lot of details. But I basically got started on accident. So right after the real estate crash in 2008, I found myself in a situation where I worked quite a ways away from where I lived. And so did my wife, Carrie, and my children went to school in that same town. So we had 3 cars that were commuting, 30 miles one way every single day. So 3 different cars going every single day. And then several days a week, we'd go back into town, to go to grocery shopping or dinner or whatever. And we sat down and we did the math and we figured out that we were literally paying enough in wear and tear and fuel on our cars to pay for a whole nother mortgage.
Oh, wow.
So we decided we had to move. We took advantage of the depressed real estate prices and we bought another house. And mistake number 1, I didn't think about the exit strategy for my other house. So I bought a house, but I couldn't sell the other house. It's really what it came down to. And so what do you do with a house you can't sell? You rent it out. And after several months of that, I just fell in love with the cash flow. So I did it again, and I did it again. And then I ran out of money, so I had to get creative. And so I started doing all sorts of different creative strategies in the single family space. I did fix and flips. I did burrs. I've done what I call an accidental wholesale. That's a different story. But I've never been an agent, and I've never been a wholesaler. And I've done 100 transactions in the single family space. And I mean, that's more, I've done more transactions than some realtors in our area as a buyer or a seller. But, fast forward several years, I built a portfolio of single family houses and I looked at the cash flow that it was generating. And I said to myself, I'm never, ever going to be able to retire on these single family houses because they don't make a whole lot per unit. And there's a lot of challenges with single family. And more important than that, I owned a business, a couple of businesses. And at that point in my life, I had a full-time job, a W-2 job. And I had this portfolio of single family houses, which was basically a third job. It took so much time and so much work to manage all these houses. I had to do something different. So in 2019, I spent a year just learning everything I could possibly learn about commercial real estate in general. Not just multifamily, but self-storage and retail and industrial, RV parks, anything that you could imagine that was commercial that I could get a commercial loan on. Some things I spent 2 weeks on, some things I spent 2 months on, but I just really wanted to learn as much as I could about it. And finally, I settled on multifamily because it made the most sense to me because I had so much rental experience. So I knew that I couldn't do it on my own because I made a ton of mistakes in the single family space, learned a ton of things like that. But in the single family space, a mistake will cost you $5, $10, maybe $20,000 is a lot of money.
Yeah.
But in the multifamily space, I was looking at $10 million buildings, $20 million buildings. And so the mistakes were going to be much, much larger. So I went out on a journey looking for a mentor in the multifamily space. And I looked at every single paid mentorship group that you could possibly imagine. And I studied them all and finally landed on one called Jake and Gino. If it's not you don't get paid by those guys, but they're a great group of people. I joined their group and really dove headfirst into that organization. And I started selling all my single family rentals and moving everything into multifamily as quick as I could. And because of my experience and the fact that I'm a pretty good teacher, pretty good coach, I was invited to go and be a coach for their academy and started teaching people how to buy multifamily buildings and apartment buildings. And I've done that now for several years. And I actually helped another group start their coaching program from scratch, got that built up, spent about 4 months with them. And now I've got a few students that I teach one-on-one directly. It's not part of a big program. They're not part of a big group. It's just one-on-one coaching that I provide to them to help them get their journey started. I'm a big fan of mentorships.
Can I interrupt 1 second? So
Yeah.
there's some people that are new here and might not understand what the BRRRR strategy is. So could you just expound on that?
Thank you so much. If I ever use any lingo or something or jargon, please stop me. So the BRRRR strategy is very, very common in single families, and it can be done in multifamily. I'll explain that a little later. But what you do is you buy a fixer-upper or a junker kind of property, right, that you would normally flip. And you go and you buy it and you fix it up. But at the end, instead of selling it, you go and refinance it. You get another loan on it. And the goal is that you refinance back out all your cash. And so BRRRR stands for buy, rehab, rent, refinance, repeat. That's the acronym BRRRR. And it's a really beautiful way if you have a small amount of capital, I don't know, let's call it 100 grand. You can go and you can flip these houses and then refinance them and get your money back. There are some problems with it though. We want to talk about why single family portfolios are not the greatest. I think Jason, they said that you're a loan broker, so you can really help me attest to this.
Brandon is up.
Brendan, okay. I'm sorry, I messed up the people there. So multifamily is a little bit different, but in single family, there's a lot of rules when it comes to loans, right? So traditional single family loans, most banks will only give you 4 or 5 single family loans, personal residential loans. And then once you do that, once you cap out their number, then you have to move on to another bank and build a whole new relationship with a new bank. And then if it's a Fannie Mae or Freddie Mac loan, they actually have another limit where you can only have 10 total loans that are with Fannie Mae. Now, there are private lenders and portfolio banks and things like that that don't have those requirements and don't have those limits. but there's just a lot of roadblocks there. And I had maxed out all of my loans. I couldn't get any more personal loans. And I'd maxed out my wife's. She couldn't get any more personal loans. So that was another reason we had to shift. Commercial is a little bit different. You don't have those limits and those requirements.
Thank you.
Sorry, went a little deep. Did I cover Burr enough, you think, Anna?
Yes, I think so. Does anyone have any questions about Burr? Just put it in the chat. Senate said, I forgot to mention, he likes questions, so just
Yeah.
put them in the chat if you have them.
Yeah, absolutely. Any questions, anything as I'm talking, sometimes I get going and go a little bit too fast. So please just stop me. So back to the story I was telling you, I became a coach. I've coached several people, but I was saying I'm a big fan of mentorship groups. And the reason I bring that up is in my journey, I selling all my single family houses, I found myself running out of capital. I bought several things as small joint ventures and small groups of people, but I saw my savings, my investing account was going to go to zero at some point in the near future. I don't care who you are. If you're investing on your own, you're eventually going to run out of money. So I had to learn how to go out and raise capital from other people. And so I joined actually 3 different mentorship groups, but one in particular that I'm very active in that focuses on just helping people set up syndications and helping people raise capital from investors. So I've actually been a member now of 7 different paid mentorship groups of varying sizes and varying levels that focus on different things. And that has really helped me build my base of knowledge and several of the things we're going to talk about today.
Can you share which group is helping you raise capital, or you'd rather not?
Yeah, I don't mind. Yeah, I'm very active in Hunter Thompson's Raise Masters.
Oh, okay.
And if anybody wants an introduction there, I'd be happy to give that. I mean, that's not the reason I'm here, but if
Do
somebody's
you know
interested.
John Lane? He's in there too.
Yeah,
Aaron
I know John
Yassin.
actually really well. Yeah.
Yeah, he was a guest here, and so was Aaron Yassin, who's also in
Yep.
there.
I know Aaron as well. Aaron's a really good,
Yeah.
good friend of mine. He's doing a lot of cool things in New York. Yeah.
Yeah, he is. We're gonna go meet him soon when the weather changes to something warmer.
So the groups I'm most active with are Jake and Gino's Wilbro Profit Academy and Hunter Thompson's Raise Masters. Both great groups. They teach different things, right? So they're good for different reasons. And then, of course, as I mentioned, I also have my own one-on-one coaching that I teach people any aspect of multifamily.
Nice. Okay, so going back to the theme of today, so let's talk a little bit about the roadmap to success, how we find and evaluate deals. Where's the best place to start?
Well, I really like to take an outside in approach, right? So you start kind of high level and from the outside and talk about inside. So first thing I want to talk about is choosing markets and choosing locations, if you're okay with that. So there's a couple of things that I teach about choosing a market. And they kind of sound opposite, but they're both important concepts to understand. So the first thing is access. Ideally, if all things being equal, the best place to invest is where you live. Now, sometimes I hear the first argument is, well, I don't live in a good place to invest. We'll talk about that in a minute, okay? But in an ideal world, you would live in one town and you would invest on the next block. Literally as physically close to you as you can, because these apartment buildings, they take a lot of work, right? They are something that you need to be able to have access to, or a member on your team has to have access to. And we'll talk about teams in a little while, but you have to be able to get to it. And you're going to know the area that you live in better than any other area. We could go around and ask every single person on this call, tell me about the bad part of town. And every single one of you could say, such and such street, you don't go there at night, right? Or something like that. Or flip that on its head. You could probably tell me where the path of progress is. The town I live in, I live on this beautiful canyon. It's a 500-foot canyon. We have a waterfall. They call it the Niagara of the West. It's where Evel Knievel jumped over a canyon, or tried to rather. It's a very famous area. But the town I live in, there's only one access point to this town. It's a bridge that goes over that canyon. And then the other access point is 15 miles that way. The other access point is 30 miles that way. Well, they're building another bridge. And it's going to take 7 years to build, but they're building another bridge. So where do you think would be the best place to invest in this town?
Near the new bridge.
Near the new bridge, right? And so my point is, you guys probably all know that kind of thing about your town. You wouldn't know where my new bridge is going in. I do. And I don't know where your proverbial bridge is going in your town. So the point is, invest locally if you can. And if you can't, what I teach is put a pin in the map at your house. Literally, put a pin in the map of your house. And then take a circle and literally do a 360-degree circle outside of your house. And keep that growing until you get to some markets where you can invest in. Because you've got to be able to get to it in a very quick manner. And if that doesn't work, then the next step would be look at your airport. And where are the cities with the direct flights? And make a list of all of those cities. Because you've, again, got to be able to get to it. Now, proximity is not the only thing to look at. So let's talk a little bit about how to choose a market just in general. Now, I'm going to say some things that are going to sound very political, and I don't care how you vote, but when it comes to investing, these things matter, okay? So the first thing is, as a general rule, I only invest in red states. Red states are better for business. Red states are better for tenant laws. They're more landlord friendly, just in general. Very commonly, they have better tax statuses, and they're just better for business all in all. So when somebody brings me a deal, if it's in a blue state, automatically red flags come up. So take that conversation that I just talked about with the pin and the map and the airports, and you filter it through that lens, first and foremost. And then the second thing, after you look at the state, always start as far out as you can, the state, then look at the city. Because some cities are more, let's say, liberal, right? Conservative. But the real answer is they're more landlord friendly, or they're more tenant friendly. So you always want to look at landlord friendly areas first and foremost. Now, every time I teach that, somebody says, well, I know this such and such town, and I know how to make money in it, and that kind of stuff. One of my dear friends who is very successful in real estate is crushing it in Minnesota, in the Tri-Cities area, many Twin Cities, Minneapolis, right? And that breaks every single rule I just said to you. But every rule has an exception. And the exception is he knows all the rules. He knows all the loopholes. He knows all the people. He knows everything about that. He's local. He knows all the roadblocks. So when we get into the team in a little while later, we'll talk about this. But if you have a teammate that lives in an area that is an expert on those things, maybe you can find an exception to that. I wouldn't invest in New York unless I was working with somebody like Aaron that Donna mentioned earlier, right? He's an expert. Then I would consider it. I also have a friend in the Seattle area. I would never invest in Seattle unless I was working. His name's Aaron too. Unless I was working with Aaron, right? Just wouldn't do it. Okay. Now, so after you look at the landlord friendly red versus blue, that type of thing. Then you've got to really look at, is the area that's the city, is it a growing city or a shrinking city? That's one of the first things I look at. I got a couple tools that I use to look at that. I got a list over here. So when you see me looking at my screen, just little reminders, okay? Bestplaces.net is one of my favorite websites. It's really, really valuable. Another one that's really good is called city-data, citydata.com. Between those two, you can really get a lot of information about the city, and sometimes even down as far as the neighborhood. So, landlord friendly, and then a growing city. I look at those two things before I ever even look at the property name.
So when you look at these websites, for example, bestplaces.net or city data, what are you looking for in there?
So at this level, it's all about growth. I want to see population growth, I want to see job growth, and I want to see income growth. Now, I know I just said this, but I want to put a fine point on it. I'm looking at this stuff before I ever look at the property.
Okay. Well, that's
Because if it's in a
interesting.
shrinking town, it doesn't matter how good the property is. And I cannot tell you how many of my students have brought me what they believe is a sweetheart property. And they looked at the problem is they looked at the property first and they fell in love with the property. And then they were blinded to everything else. So always look at this stuff first, outside, then in.
Great advice.
Now, we're going to go a little deeper. The next thing is to look at the neighborhood that the property is in. And so we looked at the state, looked at the city. Now let's go look at the neighborhood. And there's a couple of things to really look at when you look at the neighborhood. Two things in particular. First is the area income. How much money does that area make? Well, City Data and Best Places has some information on that, but the best source, in my opinion, is actually the Census Bureau. The Census Bureau publishes on a regular basis down to neighborhoods. They call them census tracts. And you can go in and you can look at, see what the area income is in that exact neighborhood. Now, some places they're bigger, some places they're smaller. Big cities usually have more tracts. Smaller cities have less tracts. But you can really see what that income is. Why does the income matter? Well,
Afford to pay rent, right?
that's right. If it's a low income area, they can't afford to pay rent. So the broker could be telling you, you can double the rent or triple the rent. But if the people that live in that area can't afford how much money to pay, they literally can't pay more. And you can renovate a property, but you can't renovate a neighborhood.
Mm.
So
Cool.
kind of the back of the napkin rule of thumb is your cost to live in a place shouldn't be more than a third of your income. So that includes utilities, right? So if their average income is $3,000 a month, they can afford to pay $1,000 a month to live there. So now you know your rent can't be more than, say, $800 or $900. Next thing I look at on the neighborhood is the crime rate. And so there's three different websites I'll give you for crime, because some websites work better in some states than other states. Okay. The first one is called spotcrime.com. Another one is called crimegrade.com. And then the last one is neighborhoodscout.com. And I literally look at all three of these back and forth, depending on the area of the country I'm investing in. And if I can't find a good thing, I just simply Google Dallas, Texas crime map, New Orleans crime map, wherever you're investing, right? Just do a crime map search for that. Because again, some cities work better than other cities. But you don't want to invest in a high crime area. Because again, like I said a minute ago, I'm gonna repeat this a few times probably. You can renovate the property, you can't renovate the neighborhood. Let me tell you a little story about that. I'm sorry, was somebody asking a question?
I said I'm going to quote you on that.
Good, please do. So funny story, I'm looking at a property in Tulsa, Oklahoma. And I'm touring this property and I'm walking around it and it just looks really impressive and I really like it. And I'm almost done with the tour. And on the way out, I see this little hole, kind of like spiderweb looking hole in the window of one of the units. And it dawns on me, it's a bullet hole in the window. And I point up at this and I say, how long has that been there? And the property manager that's giving me the tour says, I don't know how long that one's been there.
Oh, he's implying there's quite a few, huh? Ouch.
Needless to say, we didn't put an offer in on that property. So check that crime map. Something I like to do also, now this is, I'm jumping ahead to property level. So, but I like to Google the property address. And then I use a couple of keywords, crime, shots, like gunshots, and murder.
Mm.
And if you get any hits on Google for those things, you know, you can't, yeah.
So we won't tell you we have a property in a bad neighborhood that has,
A bullet
Not-
hole in the house.
yeah.
You know, it happens to the best of us. Another story I had from my single family days. Another reason I wanted to get out of single family. I was on vacation and my phone rang at 2 a.m. and I looked down and it says Twin Falls Police Department. And I'm like, why are the police calling me at 2 a.m? And of course I answer the call, right? And someone had broke down the door at my house, one of my rentals, because of a fight. Someone broke down the door and went in and fought my tenant at 2 a.m. You know, and I'm on the East Coast somewhere. I'm a long ways away from home. So I have to call contractor, wake him up, get him over there, right, to board up the door at 2 a.m. And so in multifamily, that kind of stuff can happen too in multifamily, but now you got big property managers, right? You got handyman and you got all this other resources. So anyway, the neighborhood really does matter.
Yeah, you only want to do that once, right? You're like, nah,
Exactly.
I'm done with this.
I sold that house pretty quick after that. All right. So that's kind of that outside in approach, right? So again, state, city, neighborhood, location. Any questions on like that process?
I think that's a great approach.
No, yeah, it was very thorough.
Excellent. Okay. Well, I think the next thing I'd like to talk about a little bit is partners, if that's all right.
Yes, please.
So, single family houses and rentals, you can easily do that on your own. So what I say is anybody can buy a house or a duplex and rent it out and be a landlord. And I believe that wholeheartedly. I don't think there's a single person ever that can't do that. And so, but when you do, now you're in charge of everything. You know, you have to deal with the troubles of real estate, you know, tenants, toilets, termites, that type of thing. But if you want to move into big apartment complexes, anything 20 units and up, 100 units. It takes special skills. It takes a team of people and quite a bit of money, actually. So when you're looking at a deal, after you evaluate well, actually, depending on the situation, maybe you do this first. But other than this, the area, the next most important thing, in my opinion, is the team of people that are running the deal, team of people you're working with. So if you come in and you join, it doesn't matter if you're a limited partner or if you're a general partner or if you're doing a syndication or if you're doing a joint venture, you need to treat this almost like you're getting married to these people, because you're going to be in business with them for a long time. A short deal is 3 years. Most of them are 5 years. Some of them as long as 7. And I've got a couple of them that are 10-year deals. And so you're going to go into business with these people for 5 to 10 years. So I teach 3.5 rules, 3.5 rules when it comes to choosing a partner to work with. So the first and most important thing is you need to have complementary skill sets. And let me really put a point on that and explain it a little bit. What I mean by complementary. A lot of people, they get buddy-buddy with the people that are the same. If you go and you look at groups of people at a party or something like that, you're going to find all the lawyers over here together. You're going to find all the accountants over here together. You're going to find the handymen over here together. You're going to find the builders over here together because they have things to talk about, right? They relate with each other. If you're in the real estate industry, you're a real estate salesperson, Ken, you can probably test this. You have a lot of friends that sell real estate. Just the way it works, right? Because you have things to talk about. You can relate to them. And they teach this concept that of collaboration and cohesiveness, and 1 + 1 is more than 2. You've kind of heard that before. 1 + 1 could be 3. Well, that only works if you have 2 different skill sets. So somebody that's really good at finding properties and somebody that's really good at raising money. If you have 2 people that are really good at different things like that, 1 + 1 could be more than 2 or 3. It could be 11. It can be a multiplier effect. But if you have 2 people that are doing the same work, 1 + 1 isn't even going to be 2. It's going to be like 1.5. Or sometimes if there's friction there and you're both wanting to do the same thing over and over, it's less than 1 because you're fighting with each other. And even if it's not really a fight, it's like, oh, I wanted to do that, or I did that. So you really got to be able to figure out what you're good at and then what you're not good at. And then go find somebody to fill those gaps. That's right. Positive synergy. That's what you're looking for.
So if you're just starting out, then, how do you know what you're good at?
Well, people
how-
don't like it when I say this, but if you're
Mhm.
just starting out, you don't really want to jump into bed with anybody. You want to take some time and you want to learn, and you want to find some kind of mentoring, whether that's free online education, things like this. This is awesome venue. There's this group is perfect for that. We're going to learn and you're going to figure out what you're good at. And then go out there and practice a little bit. Right? We're going to talk about finding deals and things in a few minutes. Go out there and try to find a deal. Start talking to people about real estate. Read a book. Listen to some podcasts. You're going to naturally gravitate to one thing or the other. Great question. Okay, so complementary skill sets, positive synergy. The second thing is you have to get along. You have to be friendly. The rule of thumb that I have for this is Would you be willing to have them over to your house for a barbecue with your kids there? Now, I'm not saying you have to be best friends, but we just talked about you're going to be in business with these people for up to 10 years. If you're going to dread getting on the phone with them, it's not going to work. Okay, so you have to be friendly. You have to get along with them. One of my favorite partners that I have ever worked with, like I go and stay at their house, you know, and they live on the beach, right? This great, amazing place, and they've invited me to go and stay with them, and I take them up on it. So use that rule of thumb. Would this person be welcome at my house for a barbecue? Number 3, very important. You have to have similar goals. So let's just use an example. I told you a short deal is 3 years, a long deal is 10 years. If you are really focused on long-term holds and you want to hold a deal 10 years, and that's only properties you want to look at, and they're like, I want to flip these things as fast as I can. I want in and out in 3 years. I mean, that's not going to work, right? You've got to have similar goals. They don't have to be exactly the same, but they have to be similar. So talk about your goals in life, your goals in real estate, your goals with this property in particular. And now the last one, and the reason it's 3.5 and not 4 is because it matters, but there's a lot of overlap between the last 2 things I said. You've got to have similar core values. You've got to have similar beliefs in life. They don't have to be exactly the same. I'm going to use a very extreme, some people might say offensive example to illustrate a point. If you are in church every single Sunday morning and you treat your body like a temple and you're a vegan and you're all of these other things that are just like that, and one of your potential partners is in strip clubs every Friday night and going to Vegas every weekend and living that kind of bachelor lifestyle, you guys aren't going to get along. You're not going to see the same thing. Now, there's nothing wrong with either one of those things. I'm not judging either one of them. But you see how far apart they are.
Yes.
That's important. You've got to be at least in similar spectrums.
You know, we found issues going in, like you think I don't know. Let's talk a little bit more about how you evaluate some of that, because, you know, we thought we had synergies with our partners, but then, for lack of a better word, when the shit hit the fan, you know,
We saw their true colors later on.
yeah, we saw their true colors later on.
Yeah.
So, any recommendations how to prevent
Yeah.
something like that?
Yeah, for sure. First thing is, don't be afraid to have hard questions, or ask hard questions, rather, have hard conversations. Because I have found that it's much better to bring it up beforehand than later on.
I say that about lawyers. I say that it's much cheaper to get a lawyer to prevent an issue than to resolve an issue.
That's true. That is so true. Yep.
Yeah.
A very good close lawyer friend of mine says, I get paid to prevent problems.
Yeah.
So I think that just having conversations ahead of time about the type of things that I just talked about, you know, like, what are your skills? What are you good at? What's your background? And then saying, well, I'm good at this, I'm good at that, you're good at whatever. How do you see that we can have synergies? And then talking about your goals. What goals do you have for this property? What goals do you have in real estate in general? What goals do you have in life? And then I would just straight up ask them, hey, what do you value? What are your core values? What is most important to you? And, you know, pick something that's important to you. Are you a family person? Do you have kids? Don't hesitate to talk about kids. If you're a churchgoer, ask them, hey, and if that's important to you, you go to church. Don't hesitate to ask hard questions. These things really do matter.
Yeah.
And then you get to decide how important that is to you. You know, if you're an atheist and you don't want to work with people who go to church, I'm not judging any of these people, by the way.
No,
They're
no, no.
only examples.
Yeah.
Because it's an individual decision to you who you want to work with.
Yeah.
And you need to be able to get along with them. That's what's important. And then, Donna, one thing that I think is very important, just to put a pin in this. Ask them, what happens when shit hits the fan?
That's right.
I have another story I'll tell you about. I've had one partnership that really went bad, and these people I care about immensely, and we were friends, close friends, and well, I mean, like, we were becoming very close friends, and I really do care about them still to this day. Something went bad, and they got very offended.
Mm.
They felt like they didn't get what they were promised in a deal.
Okay.
And unfortunately, there was a paperwork snafu, like you alluded to, the lawyers preventing it before it became a problem. And even though they weren't hurt financially in any way, they're still going to get paid everything they were promised. They're going to get all the money, but they just didn't get the GP share on paper that they felt that they deserved. They
Okay.
get all the money, but not the GP share. And that is what was most important to them. And I thought I was doing the right thing by them, making sure that their finances were protected, because that was what was important to me.
Mm.
But see, I didn't seek to understand their situation, what was most important to them.
Very
And so,
valuable point.
right, they didn't get what they wanted out of the deal, and it hurt their feelings. They were offended. And in hindsight, looking back at the situation, I totally understand why they were upset. And we've lost a friendship over it. And I'm trying really hard to repair it and work on it, because I care more about the relationship with these people than I care about the deal or even care about the money.
Mm.
And
Well,
hopefully someday I get
I
to
wish you luck, you know,
Thank
that you
you.
get
Thank
that
you.
back.
Yeah, hopefully I can get that fixed, right? So that's something that's very important to me. So thank you for that. Okay. Anything else on partnerships?
So do you actually do due diligence? I mean, beyond asking questions, do you do any other kind of due diligence on the partners?
I do. I Google search every single partner before I work with them. I Google search their name. I Google search their name and location. I look at their social media, because people in an interview or even in a situation like this, they present one situation, and then often on social media they put something else out completely. So I always do that kind of level of due diligence before I even consider investing with somebody. And then for general partners and joint ventures, I also do my own light background check. Most of the time, like court records and things like that are very open and public. You can just go online and you can search for court records in an area. And I look and I see about their background. And you'd be surprised what you find. Now, I don't do that for like limited partners and all that kind of stuff, right? But anybody I'm going to be really tightly working with, you bet, I definitely do that level of searching.
Thank you. Anyone else have any questions? Partnership questions?
As far as partnerships, I've heard some people say that they found it beneficial to like go out to dinner with potential partners or to go out like a group type, some type of activity that might be more, I guess, less formal, but more involved than eating dinner, I guess. Like actually doing something, doing some type of activity where there has to be some type of cooperation possibly, or there's a problem to solve, or like it's not necessarily a therapy session, but it can be something like that.
Yeah.
Like I saw some guy giving an example of a bunch of people working on a lawnmower. Like they were all men and it was like, it gives them something else to focus on. And while that happens, they have, you can get basically like emotions, or there's problems, or you can talk about other things and you can kind of get to know people better.
Yeah.
And I was wondering if you guys have ever done anything like that, or if you found that useful.
Absolutely, it's useful. And I have done things like that. First, let me just say though, sometimes that's not going to work, right? Because we now live in a global society, and I see on your name, you're in Oklahoma. I have properties in Oklahoma, so I do go there on occasion. But if you and I were going to go buy a property in Tulsa, I find a property in Tulsa and I say, hey, Jason, would you partner with me on this? And would you be my boots on the ground? Chances are we're probably going to be too far into a relationship before we could make that happen in person. And I don't know a good way to do it online. Maybe there is that I just don't know about. But I found just having those kind of conversations online is what you have to do. Now, that said, if you're both local, my favorite thing to do is to take them out golfing. And you don't even have to be good at golf to do this. In fact, it's probably better if you're not. If any of you have played golf much, golf is a sport that will show the true nature of any individual. Because even if you're really, really good at it, it's super frustrating on occasion. So you can see if they get upset when they make a mistake. You can see if they throw their golf clubs. You can see if they swear. A lot of people, they get their bad habits will come out on the golf course, right? They drink too much. I smoke a cigar on the golf course every time. So if you don't like that or you don't like that, whatever. But the most important thing is, how do they keep score? I want them to keep score, right? And I'm going to keep track in my head of their score, but what do they write down? And do they take mulligans, which is if they make a mistake, do they reset and not count the score? Do they take, sometimes they call it, there's a thing in golf called a foot wedge, which is where if you're in a bad spot in your golf game, you kick the ball into a different place. That's very much against the rules, okay? And again, it's not judging these people, and it's, I'm not a rule Nazi when it comes to golf. I mess around, I play around too. It's, you learn so much about them on a golf course over 4.5, 5 hours. The next best thing I think is a dinner. And a dinner, and I want them to pay. Now, sometimes that doesn't work, sometimes it does. But at a dinner, you're going to learn how they treat the staff, how they treat the server, how they leave their table, how much do they tip, how many glasses of wine do they have. You'll learn a ton about them. Now, is it always possible? No, it's really not. Especially like I said, in our global society, it's not. But something that I did, and it's something that's become fairly, I'm almost infamous for. If you ever come to a conference I'm at, or a meetup or something like that, I have a cigar night after every event. And people think it's because I like cigars, which is true. But you're going to sit down with somebody and you're going to spend 2 hours with them, maybe an hour if it's small or short one, and you're going to learn so much about them, more than business. And everything from literally if they're new and inexperienced to how to handle a cigar, to teaching, and are they willing to ask for help, or do they sit there and flounder? But some of the deepest conversations I've had were sitting around a fire pit with 6 or 7 other guys having a cigar. And many of those people that I met at that cigar night have become my partners.
So you need to know Mike
What
Hawkins.
if you
Do
don't
know him?
smoke?
Come anyway.
You're not
Seriously,
invited.
if I'm at that place and I'm having a cigar, you don't have to have a cigar. Just come sit down with us and join us.
Okay.
But
Okay.
more important, Ken, find your thing.
Mhm.
It
Take him
could be a
fishing,
poker night.
Ken. He does fishing.
Fishing, perfect. Let's go fishing. Fishing and I don't know much about fishing, but I can imagine it's a lot like golf, right? Like getting frustrated with the lines, or your hook getting snagged by a rock, or you lose a big fish. Like I can imagine there's lots of opportunities to have frustration and see how people treat the environment. Do they litter? Do they drink a lot of beer? There's like just so many things that can
Yeah.
happen when
Oh,
somebody's
absolutely.
golfing,
Yeah.
or I'm sorry, fishing.
Yep.
Yeah.
So-
So just to get to that cigar point, do you know Mike Hawkins by any chance? He's got-
It doesn't sound familiar. No. Mm-mm.
I'm going to introduce you. He is a cigar fanatic.
Nice, nice.
Yeah.
Oh, I wouldn't say I'm a fanatic, but I have some on my desk right here. I mean, it's,
No, he's got like a garage full, you know,
awesome.
like,
I definitely need to know Mike Hawkins.
yeah, I'll
Um,
introduce you.
My next business venture may be a public cigar lounge. May or may not be. All right. So we've really beat up on partnerships, but it is a very important thing. So any more questions on that before we move on to like deal specific items?
So how do you, is there one question in specific, like I know people that I resonate with are figure it out people, you know, that aren't just gonna walk away when things get hard. Is there, so golf maybe, cigar smoking maybe, but how do you really figure out like these are, you know, you're figure it out people?
You know, I could come up with a few questions. The one that comes to mind is, tell me about a time when you had a problem you couldn't solve. How'd you handle it?
Okay.
What's the hardest problem you've ever solved? Right? Like I could spitball 3 or more things like that. But yeah, I think just asking questions about times when they couldn't solve something. You know, and for me, it's that relationship I talked about earlier. I mean, those people that, I mean, they're still upset with me today, and I would do almost anything to solve it.
Yeah. Maybe, have you asked them?
I have, yeah, I have.
Yeah, I'm sure you have. All right, you will figure that out.
Yeah.
All right,
All right,
so
well,
I think we're good on partnerships. Yep, next.
Yeah. Let's talk about deal specific stuff. We talked about the area, then we talked about partnerships, but eventually you're gonna have to go in and actually start looking at deals, right? So now I want to talk a little bit about finding deals first, because if you don't have a deal to work on, it's pretty hard to even underwrite it or anything like that. Okay. So the first thing people do is when they start moving, especially if they move from single family to multifamily, is they go and look at realtor.com or whatever their MLS search is, and they just put in multifamily on their MLS and they set up a search like that. Most of the time, apartment buildings, things I look at, they never show up there. Now, it does happen on occasion, but most of them don't go to that kind of a website. They're going to go to totally different websites. The two most popular ones are LoopNet and Crexy. I'm sure most of you guys are familiar with that one, those two rather. But I set up automatic searches. I do set up the MLS automatic search, but I set up an automatic search on LoopNet and Crexy. But I'm not looking for deals on those websites. Now, if one comes across, great. But what I'm really looking for are brokers. The trick, the magic to finding a multifamily deal is having a good relationship with brokers. There's a saying in the multifamily space that LoopNet is where deals go to die. So what I mean by that is most of the time when a broker gets a good deal, they're going to have a list of 5, 10, 25 people that they're going to call. The broker, so imagine a scenario. Seller calls a broker and says, hey, broker, will you give me a BOV, a broker opinion of value, on such and such property? I'm thinking about selling it. One of the first things that broker is going to do is they're going to call their short list of people and say, so-and-so has a property in such and such town. They're thinking about selling it. Are you interested in that property? And they're going to come up with 3 or 4 potential buyers in their pocket. And then they're going to do their paperwork. They're going to come up with an estimate on what the value is. And they're going to go back to the seller, potential seller, and they're going to say, seller, I can sell this for $5 million, and I've got 4 potential buyers at that price. Before it ever hits the market, before it ever hits anything. That's how the majority of multifamily transactions happen. So I set up that MLS listing, realtor.com, multifamily. I set up LoopNet and I set up Crexy and any other place you can find that'll do that. And anytime a broker posts a deal to that, I go and I put their name on a list. And literally I build a CRM or customer relationship management, a Google Sheet, a notebook, whatever, of every single broker in a market that has ever listed a multifamily property. Now, at some point, like after you've got 5, 10, 15 of these, and you've done a little bit of practice, and you've got some experience behind your name, right? And I'm not talking, when I say experience, I'm not talking about buying deals, but if a broker calls you and asks you a question, you're going to know how to answer it a little bit, okay? Once you get a little bit of experience, then I would go to those brokers' websites and I would sign up for those brokers' email lists. Okay, so you already have the LoopNet and you have the Crexy, and then you have the broker's email list. Because the second thing the broker is going to do after they get a deal under contract, if those 5 people aren't going to buy it that we talked about earlier, then they're going to email it just directly to their email list. Who's on their list? So it's going to go to their email blast. So you want to get subscribed to that. Now, sometimes when you subscribe to a broker's list, they're going to call you, or they're going to text you, or they're going to email you directly and introduce themselves to you. And that's a good thing because you want to build relationships with these people. But that's why I said, don't go do it first. If you're green, you don't know what you're doing, you don't know what you're talking about, you don't know what a rent roll is or a T12 or an NOI. You don't know those 3 terms, rent roll, T12, NOI. You shouldn't be talking to brokers. So don't sign up for their list until you know what those things are. But the reason you do it in those stages is because you can also practice. You can practice underwriting on things that are on LoopNet. You can practice underwriting things that are on Crexy. Anything that comes on their email list, you can practice underwriting on those things. And why do I say you should practice underwriting? I don't care what role you play in syndications or in multifamily. If you're the deal finder, if you're the underwriter, if you're the asset manager, if you're the capital raiser, I don't care what role you play, you need to know how to underwrite a deal. Now, do you have to be amazing at it? Do you have to be an Excel guru? No, but you need to know the basics. I didn't plan enough time to talk about the different roles of a syndication. Maybe that can be next if we have enough time. But every single person needs to know the basics of every role. So go out there and practice underwriting on those deals. And then after you are familiar with that and you know what you're talking about a little bit, now you go back to that list of all those brokers and you pick up the phone and you call them and you introduce yourself to them. Notice I didn't say send a text. I didn't say send an email. I said pick up the phone and call the brokers and say, hi, my name's Brendan. I'm interested in multifamily. Hi, my name's Linda. I'm interested in multifamily. It's great to meet you. And literally just have a conversation. Some people script this thing out. They have this long bio they read to them, all that kind of stuff. Don't do that. Just be a human being. And you're trying to build a relationship with them. Now, don't jump into getting married, right? Don't be like, hey, can we go out for lunch? Or, hey, will you send me all your deals? Just, I'm calling to introduce myself to you and be honest with them. Yeah, I'm new, but I have a team of people that I'm potentially working with, right? Because we already talked about deals or partnerships. I have a team of people that are much more experienced that I'm working with. And then eventually you're going to build this conversation up and you're going to get on their list. And they're going to start sending you deals. That is one of the key things that people don't understand is how to actually get deal flow. When I am coaching somebody, I typically spend an entire hour just talking about how to get deal flow. Sometimes more than that. All right, so a deal comes into your inbox and it looks interesting. What do you do now? So I teach everybody to do a little bit of napkin underwriting first and foremost, but you can't do any of that until you have a good understanding of that market and that area. So the first thing you should do is you should find 10 OMs. Those are offering memorandums. This is like a flyer or a pitch deck for the property. You should find 10 OMs, even if they're not available for sale, even if they're old, they're past, and read every single line on 10 deals in that market. That's going to be your best source and best understanding for comps. It's going to be your best understanding for what rents can go for, what is happening in that market. Is there growth? Is there new businesses coming to town? And ideally, these would be things from different brokers, right? You get some from Berkadia, get some from Colliers, get some from Newmark, any of those different things, right? You get different opinions from these people. And that's going to help you just know, hey, what is the average price per unit for this age of property in that market? What are the average rents going for that type of property in that market? And then the thing that I kind of look at in my head is back from my single family days, there was this thing called the 1% rule. And what the 1% rule said was when you buy a property, the monthly rent should equal approximately 1% of the purchase price of that property. So on a per door basis, if you're getting an apartment complex and you buy it for $100,000 a door, you should be able to get $1,000 a month in rent. Now, let me just tell you, first of all, it doesn't work. Most cities in the United States, you're never going to get that. But what you're going to learn is what that rent ratio is for your city. Maybe it's 0.8, right? 80%. So if you pay $100,000 a door, you should be able to get $100,000 in rent. Maybe it's the other way around. Pay $100,000 a door, you can get $1,200 in rent. But by reading those 10 offering memorandums, you're going to get a good understanding of what that is. And you're going to be able to figure out pretty quickly, is this even worth my time to dig deeper in? Because you should underwrite 100 deals to close on one. I call it the 100 to 1 rule. And let me tell you what that means. Break it down for you. When you underwrite 10 deals, you should find one that you're willing to put an offer in on. 1 out of 10. That's 10 out of 100, right? Now, of those 10 out of 100, you should expect to only get 3 of them under contract. If you're getting more than 3 under contract, you're probably paying too much. You're not negotiating hard enough. I've got one right now that I have under contract, and I'm asking for a 20% price reduction after doing due diligence. Now, of those 3, you should expect 2 of them to fall apart because of things like I just said. It's a smaller property. I have it under contract for $1.5 million. I'm going to ask for a $300,000 price reduction. The owner's probably not going to take it. But that's what I need to make it work. And I know that it's just a numbers game, 100 to 1.
But you're also putting your earnest money in to get that due diligence done, right? So you have to be willing to risk a little bit.
That's right. And that's another reason. That's why I said 100 underwrites, 10 offers, expect 3 to go under contract. Right? Because those 3 that actually go under contract, you've got to be fairly sure that you're going to buy it. Because like you just said, Donna, you've got earnest money you're putting up. Now, I've only gone hard day 1 on earnest money 1 time. I don't recommend that. You should always have a due diligence period where you get that back. But there's costs to do due diligence. Travel costs, time, you got to pay contractors, you got to pay somebody to do the sewer scope. It costs money to do due diligence on a property. And if not, it definitely costs time, even if you do it all yourself. And so you've got to be sure. And then those 2 drop out and you have 1 that actually closes. So 100 to 1. All right. So I feel like we skipped ahead a little bit there. Let's go back to, you get a deal in your inbox and you underwrite it. This is not a course in underwriting. I could teach one of those, but the first thing is you need to find an underwriting template that you like, that you are good with. There's several of them out there. Michael Blanc's got one. I use one called Synthesis. That's the one that I like. I paid a little bit of money for that. I've got a couple of friends that are building one of their own. There's a lot of good ones out there. If you're interested and want to know, I'd be happy to do an email exchange and talk to you about all the ones that I like and all the ones I don't like. Michael Blanc's Syndication Deal Analyzer is a really good one. There's a lot of good
fee
ones.
for that too, right? I think it's about $150.
Yeah. Excuse me. Most of these people
use them.
Most of these people, they spend a lot of time and energy building these things, right? So a lot of the times they charge a little bit of money for them, and good for them. They should recoup their costs.
Yeah.
A lot of times though, when I first got started, people would share deals with me and they would share their underwriting file with me that was already filled out. So I have to admit, I've got copies of 20 different models, right? That they just all went into this examples folder. And that's how I decided which ones I liked and which ones I didn't. And then Synthesis, I bought it. I paid full price for it. And Chris Jackson, the guy that built Synthesis, also made a training series just on his program. And I bought the full thing. Not necessarily because I needed the training, but because I wanted to support him. So that's important too. But the point is, find one that you like and master it. Because you've got to be good at it. You don't have to do it all the time. Maybe you're the marketing person that raises all the capital, but you've got to still know the underwriting model. All right, we're going to skip ahead to a couple of different things here. So underwrite it and practice it. In underwriting, there's really a few things that I want to point out that people miss. That happens all the time. So if you're underwriting a deal, or if somebody sends you a deal that they've underwritten, you've got to look for these things. So the first one is, and it's a big one, you've got to understand the debt. If you cannot explain the debt to a 10-year-old, you don't understand it. What is this debt strategy? And how long is it good for? What happens in 2 years? What happens in 5 years? Understand the debt. And I don't care if you're a limited partner, a general partner, a joint venture. That's a very important thing. And along with that, second thing is, what is the exit strategy? One of my coaches, Bill Ham, said to me, planes don't have to take off, but they have to land. How are you getting out of this deal and when? Is there a plan A? Is there a plan B? Next
Yeah,
thing.
a lot of times, you see like either refi or sell. So, so that's your plan A or plan B kind of thing.
Sure, but understand what that is, right? So I said earlier, there are 10-year deals out there. Are you okay with your money being there for 10 years? Great, if you are. But you don't want to invest in a 10-year deal if you need a 3-year exit. So understand what their strategy is and what the exit is. And if it is a refi, understand what their plan is to refinance. And is it possible? If they said to you, I'm going to refinance at a 4% interest rate, that's probably never going to happen again. A couple years ago, that was possible a couple years ago. But nobody knows the future. There are no crystal balls. But the chances of us getting back down there are pretty slim. So I would say they need to be using something that's at least close to today's interest rates for their refinance, or even preferably slightly higher than today's interest rates, just to be conservative. The other thing that's important about the exit strategy is, what cap rates are they using? Now that's jargon, right? I understand that. Some of you may know what cap rate is, some of you might not, but cap rate is what you use to calculate the value of a property. Single family houses are based on comparative sales, right? So the house next door sells for an amount, it impacts your sale. A multifamily, it's based on the value. The value of the property is based on the income that it generates, divided by a certain cap rate or a certain number in a market. Now, what I look for in an exit strategy is, I want that cap rate to decompress over the time that they hold it. So if they're buying it at a 5 cap, I want that cap rate when they go for the exit to have grown at least 10 basis points per year. So if it's a 5-year hold, then I'm looking for that exit cap rate to be 5.5. Just so you know, the bigger the cap rate, the lower the value of a property. So if it makes $100,000, 5 cap, the NOI is $500 or $100,000 at a 5 cap is going to be worth this. The NOI is the same. The property is going to be worth less if it's a 5.5. And I know that's kind of weird and hard to understand for some people, but the bigger the number, the lower the sell price. Why do I want it to be a bigger cap rate, a higher cap rate? Because I want to estimate that the value, the real estate market is going to be worse in the future than it is now. Now, is that Gonna happen? I don't know. Neither do you. But if I plan for it to be worse than it is now, and it's as good as it is today, I win. If I plan for it to be better than it is today, and it's the same as it is today, I lose. I always want to set myself up to win. So I plan for the market to be worse than it is today. And I do that both on the refinance and on the exit. So understand that exit strategy. The next thing you really have to understand is the rent escalation. What is the rent today? And what are they saying it's going to be in a year from now? And how did they get there? Are they remodeling units? Or are they just going in and raising rents on people? And maybe they can do that, but how much can they do that? And then the first 1, 2, maybe 3 years, there's a way that you can force appreciation and force rents. You can do remodels. You can take old people that have been there for 10 years and bring them up to what's called market rent. But eventually you have to go with just what the market is. So I want to see, what are they saying the rents are going to grow in, say, years 3, years 4, years 5, years 6. And if those are more than, say, 2 or 3%, I need to understand why. What's happening? Because as we talked about earlier, there's no crystal ball. There's no way for you to know what the future holds. And anything more than a 2 or 3% rent increase, unless you've got a good reason behind it, I think is way too aggressive. I just covered a lot there. I've got one more point I want to talk about, but any questions so far? Sometimes I feel like people get their eyes glazed over when I talk about this stuff. Are we good?
Yeah. Yep.
Okay.
Yeah.
All right. So a big problem that I see in most underwriting models, something you need to look out for. When you go and look at year 1 on the pro forma, a lot of people will put year 1 at what they project the end of year 1 to be. So let's make that, let's put a more detail on that. If you buy a property, we're in January today, and you buy a property and the average rent is $600 a unit. You can't go in there February 1st and raise the rents to $900. You can't. It's not possible. A lot of these people are going to have leases. Some of them are going to be month to month. But even the ones that are month to month, in most states in the country, you have to give a 30 days notice on a rent increase. And some places it's 60 days notice. So even if they were all month to month, if you gave them a 30 days notice on February 1st, you couldn't increase their rent until March. And if you did that, if you had a 100-unit property and you went from $600 to $900 in one shot, tons of people are going to move out. And then when they move out, you probably have to go in there and do some maintenance on their unit.
Mm-hmm.
So it's going to be vacant for who knows how long it's to be vacant. It might be a week. It might be 2 months. Now, hopefully you have a plan for that in the due diligence. But my point is, even in an ideal scenario, if you bought a property today and the rent was $600 on average, and you were going to go to $900, in a perfect world, which is never going to happen, you're not going to get that rent increased until March or April. More than likely, what's going to happen is you have a $600 average now, and then in March, you're going to have a $650 average, and then in April, you're going to have a $700 average, and then in June, you're going to have an $800 average, and then by the time you get to like November, December, you're going to have a $900 average for that single month. And so what you have to do is you have to average all those rate increases over the year. So when you do your underwriting, your in-place rents, your today's rents might be 600. But your year one, even though you're getting up to 900 in year one, your average might be 750.
That's a good
And then
tip.
your year two, maybe now you're at 900 in year two. Big mistake I see people when they underwrite is they go to what the end target is in year one. And it's just not possible. So watch for that. How are they doing those rent increases? All right, two more mistakes I want to hit, and then I'll just go with questions. The next one is property taxes. Most people do not calculate their property taxes accurately. Most people assume if the property was paying whatever the number is, $10,000 a year in property taxes, that's what you're going to pay when you buy the property. Most places in the country reassess the value of a property upon sale. More areas in the country than not do that. But what you really need to do is you need to call the tax assessor and you need to understand how they value properties and when. Because in Idaho, it's not like that. In Idaho, it's what they call a non-disclosure state. The tax assessor cannot use the sale value of the property to assess it. And because they have limited resources, they only assess properties every 4 years. But they reassess them every 4 years. In other places, they're going to reassess the property when you sell it, when you buy it, and then they won't reassess it again until it sells again. So if you buy a property like that in a market where it was assessed 20 years ago, and they're only paying $10,000 a year in taxes, and it sells, you might now be paying $50,000 or $60,000 a year in taxes. So the taxes are a huge thing to understand. The next one is insurance. They might have been with the last insurance company for 10 years and never had a claim, and they have super low insurance. But you go shop for an insurance policy and it's going to be double or triple. Get a good insurance quote. And if you're in a high risk market, anywhere near water, anywhere near hurricanes, if you get an estimate for insurance, add 25%. Houston, New Orleans, anywhere in the Tornado Alley, anywhere in Florida, on the coast of California. Get an insurance estimate and put 25% in your underwriting. Additional. All right.
Yeah, I heard that's impacting a lot of the HOAs in Florida right now because their insurance quotes are going through the roof and they're trying to pass it off on the homeowners association fees, and people are like, there was one in Florida where they had to call the police because people were just so upset about it.
Wow. I'm not surprised. It's insurance is a big deal.
Yeah.
I saw a 45% increase this year on my insurance across my entire portfolio.
Wow.
I mean, some areas that, like down in Florida, I heard too that some of them, they won't even insure them anymore.
Yeah.
Yeah.
It's true.
Because it's just, sea levels are rising, and these insurance companies are just like, we want no part of this area, So, yeah.
Luckily, if you already own the property,
Mhm.
I say luckily, this is a bad scenario. But most lenders, especially the big ones, they have what they call forced place insurance. So if you own a property and you've got a loan on it with one of the bigger lenders and you don't have insurance on it, so the lender is going to communicate to the insurance broker. If you ever cancel your policy or you don't pay your policy or whatever, they're going to tell the lender about it,
Oh, yeah.
right? Automatically. And so if that policy gets canceled for whatever reason, then the lender is going to know about it. And then they're going to force you to buy another insurance policy. And if you can't do it, they have carriers, super high risk carriers,
Yeah.
that they're going to put on that policy. So, or on that building to cover their interests.
Mm-hmm.
But you're going to pay the bill still.
Yeah, I've heard about that too. Yep.
Yeah. Forced place insurance. It's not
Yeah.
good. It's expensive.
For sure. Well, we want to be respectful of everyone's time here, but this was fabulous, Senate. Thank you so much for all that you shared. Does anyone have any questions for Senate or feedback, comments?
Yeah, I do.
Okay.
Awesome.
When you were talking about selling your single family houses, how did you go about that? How easy was it? How hard was it and then roll them into the multifamily?
Yeah. So most of them I sold 2019, 2020, 2021. Pretty good time to be selling single family houses. I timed that market cycle really well. I wish I could say I did it on purpose. So it was pretty easy for me, and I just listed them with a local realtor that I have a really good relationship with, and I didn't do 1031s. I actually intentionally didn't because I knew that I was going into bigger partnerships and bigger deals like that. And I used the depreciation from the apartments I bought to offset those sales, which is a lot deeper, more advanced strategy. I'd love to talk to you guys about, 1031s versus depreciation, that type of thing. Now, the couple that I've had since the market has turned, like I still have a couple. I've got one under contract right now to be sold. They were a lot harder to sell, a lot harder. And so, luckily I've got really good realtors.
Okay. Thank you.
Thank you. Yeah, we may have to reach out to you about that whole depreciation offset on selling. That's interesting strategy. Linda, you had come on mute. Did you want to ask a question?
No, I
Oh.
didn't have a question. I just wanted to say how much I appreciated all the information. It was massive.
You're very welcome. Glad to help. I love talking about real estate and I love teaching. So happy to do this anytime.
Thank you.
Excellent. Thank you.
Can I ask a quick question as far as acquisitions? Somebody like me personally, I'm just now kind of getting into looking at acquisitions and underwriting commercial multifamily. And I'm finding a lot of places have like when you're learning, you're going through your rules and how it's supposed to look. What I'm actually finding is a lot of properties that are underwater or negative NOI, like you have serious problems. And I was wondering how much time, whenever you run into stuff like that, how much time do you spend trying to actually figure something like that out? Would you only consider something like that, like working a problem like that, if you had a team in place already, and would you just kind of leave that? Or I guess I'm wondering how much time would you spend trying to figure out if the deal is a deal, and then
Yeah, that's the question.
Got it.
Yeah.
Yeah, I got you. I
Yeah.
got you. I got you. Okay. So first, let me just say, I really believe that we get paid to solve problems. So the bigger problem you solve, the more money you're going to get paid. So if it's a big problem, you're going to make more money. But you have to balance that with, there's lots of types of returns, and I didn't go into the returns, but one of the biggest ones is return on effort. To say that another way, to say that more plainly is the project worth the brain damage?
Right. How do you figure that? Like, how would you factor something like that in? Is it like, when do you see something and say, no, that's going to be too much? And then just kind of cut your losses. And then when do you say, well, this is something I need to learn anyway. And then, it's worth it. And we'll also get, financial returns, and then we'll have, the appreciation and sell it in 3 years, something like that.
Now, that's a deeply personal question that only you can answer. But the things that I look at to answer that question is, how much work are you literally going to have to put in the property? How much time, how much effort? Do you know those skills? Are they actually valuable for you to learn? Are you there if something goes wrong? So I would look at this differently if it was in my same hometown versus, 300 miles away, 500 miles away. Because it's a lot riskier to do something like that across the country. And then I would look at the actual dollars. You put in figure out the amount of effort you put in, and then look at the actual dollars you're going to make, and do a math problem there. So, what is my hourly wage for doing this? Because if it's $20 an hour, you can go get a job and make $20 an hour, right?
Right.
But the most important thing is, so I teach. I'm going to cover it real quick. The types of returns. So everyone knows ROI, return on investment. Dollars in, dollars out, right? I also teach ROE, which is return on effort. We just talked about that. Hourly wage, basically. Then I teach return on equity. So if you've got equity in a house that's sitting there, how much money you're making on that equity? Most of the time it's zero, just so you know. Equity doesn't make money. And then the last one that I teach is ROS, or return on stress. It doesn't matter how much money you're making. If you're making 1,000%, $10,000 an hour, if you can't sleep at night, it's not worth it. It's just not.
Right. And if you're dying of a heart attack 6 months, 8 months later, that money isn't going to help you a whole lot. Doesn't matter. Yeah, those are great returns on paper, but yeah.
I've done some stock trading in my past, and I played with this one thing that was really, I made a ton of money on it. They were called binary options, and they were short term, really, really short term trades. And I was making like $100 a day or something off of a very small investment. And I screwed up one time, and I lost $10,000 in like 5 minutes. And I'm like beating my head against the wall because I lost everything I made in the last 2 months in one trade. And I didn't sleep for a week. I stopped doing that, by the way.
Right. That was enough, huh?
Yeah. And so that's really those are the things I would look at to answer that question. And like I said, it's deeply personal. Only you can answer them.
Yeah, the different types of returns, and then figure out the different types of returns, and then you kind of have to do some type of averaging there. Is it worth it?
Yeah.
Thank you.
You're welcome. Yeah,
Appreciate
it. Great answer. All right, real quick, Nigel, do you have any questions? Are you out there? He's on mute. I know he's traveling, so it might be hard. Karen, any questions?
Hello?
Oh, Nigel, hey. Yes.
Hey, Donna, how you guys doing?
All right,
Good, how are you?
good. Feedback,
No, I don't have any
questions?
questions. I'm, basically kind of getting a grasp on everything, and I appreciate The information was very.
All right, well, thanks for being here, Nigel. I'll
Okay.
go on to Karen. Karen, are you there? Karen, you're on mute. She might have stepped away. And Brendan, are you still here?
Yeah, I learned a lot. Thank you, Donna, for inviting me, and thank you, Senate. Definitely got a lot out of this.
Oh, cool. Great. Thank you so much
Very
for
well.
being here. All right, so the last thing I want to say is Senate is starting a webinar series. So why don't you tell us about that?
Yeah, thanks. I'd love to invite all of you. I'm going to put some information here in the chat. But what it is, it's a monthly education webinar series. It's mainly focused towards limited partners. My primary role in real estate is to raise capital, so I'm always looking for investing partners and limited partners to work with. The next one that I'm going to do is March 7th, and the title of it is Passive Real Estate Investing Right for You? I do a topic like this every single month, and usually the first Thursday of every month is when I do it. And there will be a different topic every single month. And they're all going to be limited partner focused. Last month it was passive income from property, investing in real estate without dealing with rentals. Next month in April, tentatively, I'm planning passive versus active real estate investing. So I'm really going to get down into the difference between being a general partner and a limited partner, or buying single family houses and investing in passively in real estate. So I'd love for all of you to come. If you know anybody that's valuable for, the best thank you can give me for tonight would be to share that webinar with them.
Absolutely will. Thank you so
Absolutely, yes.
much. Well, I know we're just over a little bit of time, so I want to let everyone go, but I thank you so much for your time and for your education. It really helped a lot.
You're welcome. Happy to do it. Thanks for the invite. Great to meet all of you.
We'll
Thanks a lot,
have you
Senate.
back another time
Appreciate it.
for sure.
Thank you. Thank you.
All right, we'll see you on your webinar. Bye-bye, everyone. Good night.
Thank
Thank you all for coming.
Bye.
See you soon.
Thanks again. Okay, bye.
Next month, Hook Up with Real Estate.
Thank you.
Find us on YouTube at Hook Up with Real Estate. Good night,
All right.
everyone.
Good night.
Good night, Senate.
Thanks, Donna. Bye.
Thanks so much. Bye-bye.